I'm Nathan. We're the Spark Investors.
So we're sitting here on lunch, and we're talking about this guy that went all in on options on Robinhood and just really lost it all. So basically, you got two different versions. You got a call and you got a put. If you think the price is going to go up, you buy a call. If the price you think it's going to go down, you buy a put, and you make money when it goes over or below. Nathan's going to break down a call option here in just a second, which is what this guy did. Stay tuned.
Hey, it's Nathan, and I'm going to take a few minutes here today and just try to explain what call options are, some of the risks associated with them, what's the difference between buying and selling a call option, and just general information that might help you make smarter trade decisions and see if options are the right investment strategy for you. So, in a nutshell, call options are the ability to buy the stock at a particular price in the future. This can be very useful because it can let you get in at a lower point than what the current market rate is. But there are a lot of risks associated with this. It's a very easy way to lose a lot of money if you're not sure what you're doing. So I do recommend until you know what you're doing, research more, watch these videos. We'll be doing more videos on options in the future. So let me just break this down for you. So I'm just going to look at call options as if I was buying one. So let's say we have a call option for 10 shares at $1. It will expire in 3 months and the premium is $10. So the first few things we want to look at this right now, get a little bit of terminology out of the way, is one, the price of $1. That's considered the strike price. This is the price at which the is executable if the price is met. Uh, it is for 10 shares, and so typically they come in quantities of 100 or more. Uh, you can't just buy like a single share option, so but just for the simplicity of this video, we decided to go with 10 shares. And then the expiration, which is in 3 months, so it means after 3 months, this option is no longer tradable or you can no longer execute it either. And so the premium is just the price you pay for it. So in this case, it was $10 to get 10 shares at $1. So let's say in month one, the stock starts out at 50 cents. And by the end of month one, the stock goes up to, let's say, just right above that dollar mark. And so you can see on there, I have written in the money and out of the money. And what this means is when it's above a dollar, it's considered in the money. In other words, the call is executable. Uh, it has value. However, for me, since I paid $10 for it and I'm looking to go ahead and execute it, it's still not breaking even for me until it hits that $2 mark, which is that kind of squiggly line you see there. So let's say in month two it drops back down below, and it's out of the money again. So let's say stock drops to, let's say, 60 cents from a dollar. So now it's considered out of the money. It's not completely worthless. However, it'll probably be worth less than what you paid for it since it's already halfway up, and it's not in the money anymore. So let's just say something outrageous happens, the company shoots up to $5. So in month three, I can now call in the call option, buy the stock for $10. So my initial investment point is $20. But I can sell the stock for 50, meaning I can net $30. Uh, that is one easy way, and the break-even point is pretty easily calculated by just saying the share price times shares plus the premium, all divided by the shares, and that will tell you what the break-even point will be for your option. Uh, Now, let's take a look at this as if I was going to sell it. So, if I were going to sell a call option, let's say I wrote this up for the 10 shares at $1 for 3 months. Let's say I sold it to Kevin. So I would make that $10. That $10 premium would be mine. But I would be undertaking a risk with this. I would be telling Kevin that I guarantee at any point within the next 3 months, if you contact me and the strike price has been met, which the strike price is $1, I will give you 10 shares at a dollar each. So if the share price goes up to $7 and it calls in, I have to buy 10 shares at $7 and sell it back to him for a dollar each. So I have the potential to lose necessarily at basically an infinite amount of money, hypothetically, but I can only make up to $10. So other things I can do is like in month two when the stock drops down to 60 cents, the option as a whole was originally worth $10, but because it's closer to expiration, the value of it has decayed, especially since it's not above the strike price. That means it's worth less than what he paid for it. So let's say it dropped down to $5. I could buy that option back from him, and I'm still making $5. But I've also made sure that I've mitigated any risk I might see. So those are some of the risks and whatnot associated with selling one. It just makes you liable for fulfilling the option and whatever stated. And if you buy an option from somebody and then you turn and sell it to somebody else, you are now considered responsible for fulfilling that until they either sell it back to you or they sell it to somebody else. Uh, so there's quite a few ways to lose money, quite a few ways to make money. So basically, though, when you want to sell a call option is when you're betting the market's going to go down. That way you can net that premium, and it's just a pretty easy, not necessarily easy, but it's a pretty clean way to make some money. So I'm going to extend this example out a little bit further. Uh, so let's say in Robinhood, I only have $10 in my account, and I use that $10 to buy this call option. Uh, so at the end of 3 months, let's say I forget to check on the option and it automatically executes in the money. So what Robinhood will do is they'll charge me $10 to buy the stock. So this is going to take my account down to negative $10, which doesn't look good at first, but it's only going to stay like that for a day. And what they'll do is right after the stock's quote unquote in your name, they automatically sell it back at market for market value. And they'll take the difference between what you paid and what it was sold for and deposit that back into your account, and that will be what money you made. So if it's only, let's say it executed and it was only at $1.50, meaning that they were able to sell the stock for $15 uh, total at the market, which means I still lost $5 off the premium because let's remember my break even point was $20. So if it only sells for 15, I'm still losing $5, but my account now is just going to show a $5 balance versus zero. But if it, let's say it executed and the stock was at $5, so that means it's going to sell for $50. They're going to take that $10 away from it to cover the fee to buy the stock, which is going to put me at $40. And then once I take away the premium cost of 10, I've made $30, which is uh, one easy way to trade options to increase your account if you don't necessarily have money for the stock. But like I said, if it executes and it's not above your break even point, you're still going to lose money. So it's still a pretty easy way to lose money if you're not careful. And if you do have enough money in your account to go ahead and buy it and hold, you can sit and hold the stock. You don't have to immediately sell it back if you're expecting it to continue to increase, or you can just go ahead and sell it and try to get out with what profit you can. So call options give you the ability to buy stocks at a certain price point in the future. So you'd buy one if you're expecting the value to climb. That way you can get in at a lower entry point than what you expect the future market value to be. This also allows you to trade some bigger name companies like Apple, Amazon, Tesla, things like that without having the capital to upfront the stock cost. Uh, the only risk you assume is losing up to the premium you pay. So however much you pay that premium is the maximum amount of loss you can have. Your gains are technically infinite. So when you sell a call option, you're expecting the market to go down. Therefore, your profit is capped at whatever the price of the premium is, and your loss is theoretically infinite because if they decide to call in or if the strike price is met at any point during that 3 months, they can call it in. And since stock can climb an infinite amount, uh, you can lose an infinite amount of money. You can mitigate this risk by buying it back after the stock either goes down, so the premium is worth less money, or let's say the stock is climbing and the premium value is climbing as with the stock. You can try to buy it back from the person you sold it to, or of course it'll be at a loss. However, you'll mitigate your losses at that point. So if y'all have any questions, feel free to leave a comment below and we'll make sure to get back to you. And thank you. We'll see you in the next video. Hey, it's Nathan, and don't forget to use our links below to sign up for either Robinhood or Webull. Both will give you a free stock. Webull will give you 2 free stocks after you deposit your first $100 into the account. So go ahead and get started today and start investing in your future.